Hi everybody, this is Lance from Thetatraderz. I got my golden doodle here to help. Could you let me make the video? Is it okay to make the video? Alright, well, this video I want to go over some selling strategies, selling puts, and then looking for possible upside. So what we're going to do is we're going to use the credit from selling the put, and then take some of that credit to buy either put call debit spreads or ratio spreads in order to get some possible upside in a position. Um, Ideally, you want to set this up where you do have an initial credit and then possibly make bigger upside. So one of the biggest things about selling options is if you just sell a straight put, yep, there's a squirrel outside. If you sell a put, then the max profit you could get is just the initial premium. So we're going to look at different strategies where you could make some possible gains more than the just sold put if we get some possible upside. And we'll also look at some positions that you could do this with. Let's get right to it. All right, so here's some ideas of what I'm considering to get some possible upside. I'm just going to show a few examples here. So here's SOFI. SOFI does have earnings on the 27th, and it has been going down quite a bit. It was in the 16s, now we're at 14.15. So a possible trade that you could do is to sell a put that's past the earnings. So maybe I'll go 19 days out. What you want to do is sell a put, being okay with wheeling it out if you need to. So if it happens to drop, you're okay taking shares at a lower price. I could look at selling maybe the 13 strike price. Here you get 58 to 67. Probably get at least $60 on this trade. And then what you could do is buy a put credit spread. Look to buy it near in the money. So maybe I buy the 14, sell the 15. And then by doing this, you have a put debit spread where you can make an extra $100 if it happens to go above the 15 strike price at expiration. And you're also taking in a credit when you're starting the trade. So you get only $21 on the trade. Notice how the max profit would be the initial credit you take in, plus the $100 in the call debit spread that you get. So this does give you some possible upside. You could go even higher up if it happens to have really good earnings. You could sell the 16. This gives it a 2-whiff spread, and then you can make even more possibly. This does starve initial debit though, so you might want to sell a little bit higher up to get more premium on the sold put. And then you still get an initial credit on the trade. This one does give you a max profit of 2 with 16 minus 14. So that's $200 plus the initial credit of 10. So this possible trade, you can make $210 off to $644 in margin, which is a really good return. Another way to consider it is with ratio spreads. Now, if you do a call ratio spread, you're going to need a little bit more funds than just selling the put. But let's say we're bullish on SOFI. We could sell near the at the money put, taking them at 1.28. And then I might buy a 15 and actually buy 2 of these. Change the quantity to 2. I'm going to change this quantity to 1. And then you could sell 1 put to get some more credit. Maybe sell around the 18. In this case, we do have a small debit. Probably want to make it so it's a credit. If you move it up to the 16 strike, I'm going to buy 2 at 16, sell 1 at 18. This does give us an initial credit. Notice how the max profit is infinite in this case, because in this case with the call ratio spread, I'm buying 2 at the 16 strike, only selling 1 at the 18. So you could consider this as a call debit spread with an extra bought call. So in this one, if it goes above 18, I would make on the call debit spread $200, 16 minus 18, but then I still have that extra bought put that could give us unlimited upside and get up to infinity profit. Again, this would be a pretty bullish trade because there are earnings coming up, and also you have to be okay with getting a sign on the 14. you might have to wheel it or take assignment on this and possibly sell covered calls with the wheel strategy on it. But these are some ideas on how to structure a trade so you could get more than the initial credit if it happens to move in a positive direction in this case. You could also do them the opposite way. If you sell a naked call and then buy a put debit spread or buy a put ratio spread, if it happens to drop a lot, you can make quite a bit as well doing it that way. One last thing is I'm going to use my Theta Pro indicator where it shows bullish setups. So just going to look through my watch list and see some other possible positions that could work. Market was down quite a bit, so it might be a little hard to find, but I'll go in the daily chart here and just going to go through my watch list, see if there's any sell put indicators. Again, it might take a little while, but pretty straightforward once you got it. META actually is. So META's been pretty bullish above the EMAs in the middle of the Bollinger Bands. Could get a possible trade here for META. Using the same structure that we talked about. Earnings in 12 days. Maybe you go out to 40 days. You could sell a put around the 580 or so. Taking 1865. And then we could look to buy maybe a call ratio spread or call debit spread, 620, 630, something like that. This does give us quite a bit of credit. And you have a 10 with here, you can make an extra $1,000. If I buy an extra 620, then it is a debit. So you're probably going to want to go a little bit further out of the money, possibly. So you lower the amount of your debit. In this case, it's a bit hard to make work just because that debit is so high. Probably makes more sense to just do it as a call debit spread here. Taking a good premium here, $1,270. And you could possibly make another difference of these is $1,500.